Welcome to the Deep Dive. We get you informed fast by unpacking complex reports.
That's the plan.
Today we're looking at an independent equity research report on Persistent Systems Limited. Standard BUY call. They're calling it a special opportunity.
Strong language.
Yeah, predicting a 22 to 30% upside potential. Target price between Rs 6,306 and Rs 6,726, all within a one-year view.
Okay, so a fairly confident short to medium term outlook.
Right, so our mission is really to figure out, what's behind this special opportunity label. Let's unpack this. So Persistent's Q1 for FY26. It kicked off with a pretty healthy set of numbers. Revenues grew 3% sequentially. That's up to Rs 33.3 billion.
Okay, steady growth. What were the main drivers?
Well, digging into it, their BFSI segment, banking, financial services, insurance has shot up by a solid 9% quarter over quarter.
Wow, 9%. That's significant.
It is. And software and high tech wasn't far behind either. That grew 3.6% QOQ.
Interesting, though, because while those were strong, the report notes the healthcare and life sciences vertical actually dipped slightly, about 2% QOQ.
Yeah, that's right. What's the story there?
Well, the report says it was due to a planned project transition, a key customer thing.
Yeah.
So it temporarily shifted some revenue out of the quarter.
Okay, so not necessarily a demand issue.
Exactly. And despite that dip, they still expect the segment to grow overall in FY26, although they do mention some supply chain issues in subsegments tied to China. So it sounds more like a strategic adjustment.
Gotcha. And looking geographically.
Europe really stood out, up an impressive 11% quarter over quarter.
11%.
Yeah, followed by decent growth in India and North America, too.
Okay, so top line was pretty robust overall. But what about margins? EBIT margins.
Right, so EBIT margins landed at 15.5%. That's actually a slight dip, just 10 basis points, 0.1% compared to the last quarter.
Only slight. But why the dip with good revenue growth?
Good question. It seems like a mix of things. On the plus side, ESOP costs were lower.
Okay.
But that benefit was pretty much canceled out, mainly because an earnout reversal they had previously didn't happen this quarter. That's specific income from an old acquisition.
I see. A one-off factor disappearing.
Exactly. And then add in a shift from on-site to off-site work, some delays in ramping up certain client accounts, and a bit of negative foreign exchange impact. So several moving parts kind of balancing out.
Right. That makes sense. Operational juggling. But despite those margin pressures, the deal wins look really strong, don't they?
Absolutely. This is where it gets interesting, I think. The total contract value, TCV, hit $520 million.
Which is up 13% year over year. That's solid.
Very solid. And the annual contract value, ACV, also strong at $385 million, up 14.2% YOY. That's just, healthy future revenue streams.
That's real momentum.
And if you tie those wins to the bigger picture, well, Persistent has some really ambitious targets.
Like the $2 billion by FY27 guidance.
Yeah, they're sticking to that. And they're aiming even higher, talking about $5 billion by FY31.
Wow, $5 billion. That's quite the goal.
It is a real moonshot.
Yeah.
And crucially, they see continuous investment in tech, especially AI, as absolutely vital to getting there. It's integral to their whole strategy.
And they're not just focused on the top line, right? There's talk about margin improvement, too.
Correct. Management's aiming for a 200 basis point improvement over the next 2 to 3 years through things like better pricing, getting more leverage from their SG&A costs, and just general operational efficiencies.
Makes sense. I also saw they postponed a wage hike, and ESOP costs should be stable.
Yeah, citing macro volatility for the wage hike delay. And stable ESOP costs for FY26 should help the margin side, too.
Yeah.
Oh, and they've got a new chief marketing officer, Shimona Chada.
Okay, so lots of strategic moves, but every deep dive needs to look at the risks. What are the potential headwinds here?
Definitely. The report flags a big one. Revenue concentration. North America still accounts for 80% of their revenue as of Q1 FY26.
80%. That's high.
It is. And it makes them quite exposed if there's an economic slowdown in the U.S., which, many are anticipating. It's a lot of eggs in one geographic basket.
Right. And that ties into the broader challenge, doesn't it? The weak macro environment.
Absolutely. Clients are being cautious. They're delaying spending decisions. That's putting pressure on the whole IT industry, really.
Yeah, you hear that everywhere. Clients holding back, making things tough.
Mm-hmm.
So, okay, we've got healthy growth, ambitious targets, AI focus, but also significant geographic risk and a tough market. Given all that, why the strong BUY? What's the core rationale for you?
Right. So the report argues the buy comes down to Persistent's really strong position in digital services. It's not just offering them, it's their specialization.
Okay.
Plus their knack for winning these complex cost takeout deals, which are super valuable when clients are tightening budgets.
Helping clients save money. Always popular.
Always. And they're also getting more traction in managed services and, crucially, in GenAI services. The report basically bets that these strengths will let Persistent outperform competitors.
And justify that premium valuation, that's special opportunity tag.
Precisely. That's the core argument.
Okay. So, to sum it up for you, Persistent seems to be showing good growth, really pushing hard on digital and AI with some big ambitions. But, they're also juggling that heavy reliance on North America and the generally cautious spending environment.
Yeah, and understanding this kind of analysis, looking at more than just the headline numbers.
Absolutely. So here's something for you to think about. We heard the report emphasizes AI investments, right? But we also know the macro environment is cautious. So how critical will Persistent speed be? How fast they can scale and integrate new AI solutions for maintaining their edge and hitting those huge long-term goals, especially if the market stays choppy?